Assalamualaikum warahmatullahi wabarakatuh. My name is Salwani binti Affandi from UiTM Terengganu. Today I'm going to present one of the finance paper titled The Determinants of Liquidity Risk, Evidence from Conventional and Islamic Banks in Malaysia. And the credit also goes to the first author, Amirah Noor Iskandar from UiTM Terengganu, and the third author, Nabila binti Abi Syukur from UiTM Terengganu Negeri Sembilan. Okay, so let me start the presentation with the introduction. The definition of bank's liquidity. It is a measure of ability where short-term asset can be converted into cash to meet short-term obligation. Liquidity risk arise when the bank does not have enough cash in hand or lack of investment that cannot be bought or sold quickly enough to prevent or minimize loss. This is mentioned by Mazreku, 2019. And then the global financial crisis in 2007-2009 highlight the financial system exposure to the liquidity shock and reveal that the bank failure is very harmful to the shareholder interest, the banking system stability, and also the economy. So Basel Committee on Banking Supervision proposed to harmonize liquidity standard with the liquidity coverage ratio so that the banks strengthen their liquidity no matter what situation might occur. Goodhart 2008 stated liquidity risk happen when depositors rush to withdraw their money due to doubts insolvency of institution and cause liquidity shortage. And it can collapse the whole financial system in the country when bank panic occurs. When the collapse happen, it means bank fail to meet deposit withdrawal of the customer. Okay, and then this is very important for the bank to maintain adequate liquidity to withstand various events. So here is the objective and the scope of the study. All right, and then the literature review. Okay, so here I'm going to highlight the measurement used for this study for the liquidity risk as the dependent variable. There are the previous researchers used the total deposit to total asset. Okay, there is also use the ratio of cash to total asset, ratio of capital to total asset, and the current asset to total liabilities. So these are the previous researchers that have done the same topic in the liquidity risk and the method and their findings in their study. Alright, so this is the bank size, literature review, ROE, capital adequacy ratio. Okay, and then I have summarized all of the variable used in this table, and then these are the results that we expect from the study based on the literature review. Okay, so there is size, return on asset, capital adequacy ratio. There are mixed results here. Okay, then size we expect to be positive, ROA positive, capital adequacy positive, ROE positive, gross domestic product negative, and inflation to be negatively related with the liquidity risk. All right. So here is the research methodology, the theoretical framework. So these are the variables used in this study. Okay, the first one is the size, the bank size, and then number 2, ROA, return on asset, capital adequacy ratio, return on equity, gross domestic product, inflation, and the dependent variable is liquidity risk. Alright, so next is the model estimation. Okay, so here is the linear equation of the model estimation, which is LR is equal to liquidity risk equal to beta 0 plus beta 1 size ROA CAR for the capital adequacy ratio, ROE, return on equity, GDP, gross domestic product plus inflation. Okay, next. So the variables used. Okay, so we extract the data from Econ Thomson Reuters and Trading Economic of 33 banks, including the conventional and Islamic bank. Okay, and then we have run or analyzed the data using the Stata 14 package. So here is the variable used, liquidity risk. The measurement is total deposit divided by total asset. Size is equal to total assets of the bank. And then ROA is equal to profit after tax and zakat divided by total assets. Next, capital adequacy ratio, total capital divided by total asset. ROE is equal to net income divided by shareholders' equity. The GDP is the value of growth of the GDP. And then the inflation rate is the value of inflation of our country. So the definition given in the second column. Alright, so here's the findings, the descriptive statistics of the data run in the Stata 14 package. Okay, here is the correlation analysis and the multicollinearity test. So we can see here there is no multicollinearity problem as the mean of VIF is less than 5. Okay, next, I go straight forward to the regression analysis, which is a pool ordinary least square. Alright, so here is the last or final finding of our study. Alright, so the discussion. The result has uncovered that bank size is found to be significantly affecting literature review. The result is in conjunction with Akhtar 2011 and ICCOMAH 2012. Both studies have positive and significant result between size and liquidity risk of the bank. The reason behind this is the bigger the size of the bank, the higher liquidity risk. Okay, because banks have the better ability to establish big market share and generate higher profits. Therefore, the banks are more exposed to the risk or liquidity risk. Okay, however, the result showed are contradict to the expected result. Okay, however, Abdullah and Khan, Abdul Karim, 2013, Anam and Ahmad stated that the smaller the size of the bank, the higher the bank are exposed to the liquidity risk. Okay, return on asset is also found to be significantly affecting liquidity risk of the bank. This result is similar with Ahmed, Swada, Al-Zobi. And then Al-Zobi revealed that the given number of assets, this asset can be spread by the management of a bank between high liquid asset with low returns and high return illiquid asset. The more return on asset the banks are, the more risky they are exposed. This to say that the bank have to use up their asset to get profit. Therefore, they do not have backup asset to liquid into cash. And then therefore, banks are more exposed to liquidity risk. Besides that, a study done by Muriti et al. 2017 in Kenya said the profitability or ROA has a negative relationship. This is because the banks hold liquid asset as an obligation and may lead to low bank profitability as low returns are expected. Therefore, when there is no enough liquid, it cannot obtain funds through liabilities or even by converting asset. Hence, it affects the profit. When it affects the profit, the banks are at a dangerous state. Next, the capital adequacy ratio also found to be a significant factor affecting the liquidity risk. The reason behind this is because the bank with higher liquidity risk tend to have lower capital rates. And then the result is in line with the study done in Albanian banking system. Okay, notice that the negative relationship between capital adequacy ratio and liquidity risk. And then the justification is because banks with higher liquidity risk tend to have lower capital rates. Dahl and Schreif, 1992, find that capital and risk have a negative relationship too. It stated its reason that risk occur in a flat premium is paid to depositor. As a consequence, we can conclude that the higher risk could be minimized by sufficient capital requirement. And as a conclusion, the results show two variables are opposite with the expected result. Okay, and however, we have justified why. And the return on asset and capital adequacy ratio have negative and significant relationship with the liquidity risk. Meanwhile, size show the bigger the bank, the higher the liquidity risk, which means the positive relationship. And the other variable like return on equity, gross domestic product, and inflation rate are not significant at any level. I think that's all for my presentation, and thank you and Assalamualaikum.